Hey everybody, it's John King. It is Friday, the 20th of December. We are just 5 days before Christmas, and I wanted to give you my market update. This one's going to be a pretty big one. I'm not sure how long it'll be, but it'll be a pretty important one. Let me say that. So we have got a lot that's happened this week. Not a whole lot's going to happen next week or the week after that because we're going to be in the middle of the holidays, and the markets kind of start shutting down for the holidays. But I want to give you a lot of great updates today because there's a big shift in kind of how I'm looking at the markets, how I'm looking at interest rates, and really what I think is going to happen into 2025. So here's what we're going to talk about. The first thing we're going to talk about is why are mortgage rates going up despite the Fed cutting interest rates? So the Fed cut rates again today. Mortgage rates are going, or Wednesday, mortgage rates are and have been going up. I'm going to talk about how the Fed's comments influence long-term interest rates. I'm actually going to correctly type that so that when I pull it up again, it will say influence instead of influence. And so we're going to talk about how the Fed influences long-term interest rates through their comments. And then we're going to talk about what this means for home buyers and sellers in the real estate market heading into 2025. And I'm going to give you an update on Dream for All and kind of where we're at because it's a critical week next week and the week after. And so we'll talk about that for those of my watchers, subscribers who are following along with the Dream for All program. All right, so let's dive in. Why are rates going up despite the Fed lowering interest rates? Well, here's the deal. The Fed only controls short-term rates. The Fed uses short-term interest rates to pull strings in the market to accomplish their two goals. I've said this many, many times. I'll say it again. The Fed's two goals: keep inflation low and keep employment high or unemployment low. So they want to maximize employment, have the most number of people working while minimizing inflation. In other words, keeping price stability. Now, inflation is a good thing because if you're a producer of goods or services, you want a pay raise. You want to make a little bit more money every year than you did the year before. Well, you have to charge more for your goods and services. Your employees want a pay raise. You have to make more money on your goods and services in order to give them a pay raise. So there should be some inflation. But the Fed has been solely focused for really the decade from 2010 to 2020 on fully focused on employment. They were worried about the economy. They were worried about keeping people employed. You had the major crash in housing that happened in 2008 that led to a major depression, recession in employment, specifically in housing and construction-related jobs. But a lot of industries had that problem. And so the Fed focused on keeping rates ultra low because that would spur companies to spend money and to hire employees. And so I want to show you kind of what has happened with interest rates, mortgage rates, as we look back to 1972. So in this chart, we're going all the way back to 1972. And the only thing I want to pay attention to is this line. It was right here where my cursor is. Hopefully you can see it, where it's 5%. So we had rates never, ever below 5%. They tickled it. We were at 5.2 in 2003. They tickled it again in 2004. And they kept kind of tickling it a little bit, and they finally crossed through and below 5% in 2009. And then by 2010, they had fallen. They were above 5% in April of 2010 for the last time that entire decade. We never, ever saw interest rates below 5% for a dozen years. And you notice we came really close to 5% when we were right here in 2018. We were at 4.86, 4.9%. We were really close to 5% interest rates, but we never broke above it. So that line held really firm. And if you look at the last 55 years of history, 55 years? 50 years of history, 55-ish. Yeah, you look at the last 55 years of history, 52. You're seeing rates never below 5% except for a 12-year timeline. And now we're back above it. There are some people arguing that that was simply because the Federal Reserve was focused solely on keeping employment high because inflation was not a problem at all. And it's true. Inflation was not a problem at all during that decade. So the Federal Reserve had the right to focus solely on employment. Well, now the Fed's got to worry about something else. They have to worry about inflation. 2022 comes, inflation skyrockets. Now we say, I've been saying, I said at the end of last year, hey, the Fed's ready to start lowering rates. Inflation is under control. That led us to believing that the Fed was going to push rates back down to where they were. There's some arguments out there right now saying we're not going to see rates below 5%. I'm not sure if that's the case, but for a while, I thought there's no way that's the case. This is the new norm. But as you look at the bigger picture of things, maybe it's not the new norm. Maybe the rates below 5% were only the new norm when you didn't have any issues of inflation at all, when inflation didn't matter. Kind of like for the last 2 years when employment didn't matter. Employment was super strong, and the Fed said, I don't care about employment. I have no worries about employment. The only thing I'm worried about is inflation. And so they drove rates up. And that's how we ended up with rates back over 7.5% and 8%. Now, right now, we're tickling close to 7% interest rates. Why? Because the Federal Reserve has been changing their comments. The Federal Reserve has been changing their expectations. And I'm going to try, I'm not sure if it's going to be big enough. I'm going to try and make it bigger like this. Maybe that's better. Let's get rid of my banner here. I know I've got some questions. Feel free to keep posting your questions. I'll get to those in a moment. But let's get rid of this guy. All right. So the Federal Reserve, hopefully this makes sense. This is what's called the dot plot. The one on the left is the Federal Reserve's dot plot from a year ago, from December of 2023. What they said is, hey, right now, our rate is between 5.25% and 5.5%. We expect it to stay there for 2023. But in 2024, two people said they expected it to stay at 5.5%, but most of them said they expected a quarter, a half, 3/4, 1% rate drop. So most of them, we've achieved that, by the way. We achieved a 1% rate drop. Mind you, it took until the end of the year. We got there. We got a full 1% rate drop. Now, if we look at last year's mortgage rates at this time, mortgage rates last year, let's zoom way in. Will this one allow me to zoom in? Hold on. Let's go back here. Oh, I don't like this version. Hold on a second. There's another version. Right here. Come on, go back to the other version. All right. So, switchback is what I want right here. Perfect. I like this one better. So this one lets me zoom way in and say, let's look at exactly what happened with interest rates right now since 2020. And what we saw is last December, we were at rates of 7.79, October. So we are actually 1% lower in rates than where we were last year. The Federal Reserve controls short-term rates, but those influence long-term rates. Well, guess what? Rates went from 7.79 to 6.6 in between October of last year and January of this year. Yet the Federal Reserve didn't start lowering rates until September because the mortgage market is trying to predict what the Fed is going to do. So now the Fed right here is telling us what they're thinking they're going to do. And they said, hey, we're going to see about a 1% drop in 2024. They nailed it. They nailed it. They did exactly what they told us they were going to do. Then they said, we're going to see probably another 1, 2, 3, 4, maybe a point to a 1.5% drop in 2025. And this year they're saying, hey, in 2025, we're all thinking we might have only a 0.5% drop instead of a 1% drop. They were projecting in end of last year between a 1% drop in 2024, that happened. They were also projecting at the end of last year that in 2025, they were going to go another 1 to 1.5% lower. As of Wednesday, they said, nah, we're only going about a 0.5% lower. And there was pretty strong consensus between all the Fed members saying we're only going a 0.5% lower. So there's not the room for rates to drop like we thought. So I'll actually bring this up. So we've got comments from the same person. So in reality, his inflation is not good, especially after years of all-time high. It devalues our currency. It absolutely does. And so inflation is not a good thing for too much, but a little bit of it is a good thing. You're 100% correct on the next comment. Wages are not keeping up with inflation. They're not, but a big part of it is we had between 2010 and 2020, we had almost no inflation and we had significant wage growth. So what's the right number? Are wages not caught up to inflation over the last 2 years, or is inflation finally catching up to wages over the last 15 years? We can argue that back and forth. You said they cut too soon. Should be at rate should be at 10 to 1 to 1.5. Not really sure where you're going with that, but I do like this last comment. Lenders saying marry the house and date the rate are greedy people looking to make a commission anywhere possible. Home auctions are rising. Next year is looking bad for the bag holders, aka homeowners. Okay, so I'm going to comment on that in a minute. I don't agree with how far you're going with it. I do agree that there's a lot of concern that we drank the Kool-Aid a little bit too much. And that rates aren't going to drop anywhere near as quickly. So I do think marry the house and date the rate is not playing out well for those that talked about it. I think I did 3 temporary buy downs. I don't think they're a great idea. But the fact of the matter is it was definitely not what people expected it to be. No different than the Fed in 2022 when they said high inflation was transitory and going to go away. They were wrong. When they said inflation's now here to stay, and everybody's like, no, we think that it's coming down again. It did. Inflation did come down, but it isn't changing the longer term outlook. Why? Because of something called the normal rate. Now, the normal rate is a concept I am not going to go deep into, but very simply, it is the unknown rate at which the market is in balance. And there is a lot of reason to believe the normal rate has moved up. And so that means that the Fed doesn't need to lower rates very much to get back in balance. Bottom line of all of this, guys, is the Fed is saying things in their comments. Even though they're lowering rates, their comments are saying, we're not going to lower them as much in the future as we thought we were going to. And the bond market, the mortgage market, we've always been forward looking. We've been looking at their projections saying, you're going to drop it a whole lot. By 2026, we expected rates to be down in the threes. This is the Fed funds rate. Okay. We expected rates to be down, below 3, like in 2.5 or 2% range for the Fed funds rate. By the way, it's been at 5.5. So they were expecting a 3% rate drop by 2026. Now they're saying, nah, we might be in the mid to high 3s by 2026. And 2027 is going to be around the same place. Long term, they think maybe we have 1% lower to go. That's it. That's what they're saying. Maybe we have 1% lower to go. That's the concern. All right. So what does this all mean? Let me go back over here. I'm going to stop sharing this. Go back to me and go back over here to my banners. All right. What does this mean? Well, kind of like the comment that I just got, it means that you've got to be thinking long-term about, hey, how is this going to play out to my long-term financial situation? Can I afford this long-term? Now, you're going to continue to get pay raises. And so with those pay raises, it's going to make it easier for you to afford the payment. And the truth is, a lot of people aren't going to be able to buy homes that thought they were going to be able to buy homes because they thought rates are going to drop significantly. We're going to be in fine shape to be able to qualify. I said, hey, I'm a little nervous, even though you're waiting for rates to drop. And I thought rates were going to drop faster than they are. I also expected and still expect that when rates do drop, we're going to see house prices go up. Okay. It's not going to make it more affordable. So buying now, marrying the house, dating the rate, the concept was good. The execution is not, because at whatever point rates do drop, we're going to see house prices go up. But until then, we've got some pockets of the country. We've got some cities that are struggling right now to have homes sold. I'm hearing stories of different markets that the amount of inventory has tripled and quadrupled in the last 3 months. Now, there's something to say about the holiday season and the fact that houses don't move very much during the holiday season. And I agree with that concept. But there's the other side of the coin that says, but that normally means there's fewer sellers. So why are more sellers coming on right now? I think part of it is because they just can't wait any longer. I think a lot of sellers, there are cracks that are showing. I talked about this a couple weeks ago. There are cracks showing in the housing market, and sellers have been kind of limping along. Homeowners, some have been limping along saying, hey, I'm just waiting until things get better. I'm just waiting until things get better. And they can't wait any longer. People have been waiting to move until it was a better market to move. And now they're like, look, I just have to make the move. I can't wait any longer. And so we're in that place where you've been waiting so long for something to get better and it's not getting better. And so you just have to make a decision to do something to accomplish your goals instead of waiting for the perfect time. And I think that's what we're dealing with right now. It means that as a buyer, you should have more opportunity to negotiate. But the truth is, I'm hearing stories on that side that say homes are being snatched up immediately and I can't get an offer accepted. What are you talking about, John, that there's lots of homes on the market? And it has to do with the price points and the geography. That's exactly what I'm seeing. Is we're seeing two different markets right now. We're seeing starter homes, entry-level homes, first-time home buyer homes. They're being snatched up immediately, quickly, at or above asking price. Homes in senior communities, homes in out in rural areas further away from the big city, bigger homes that are move-up homes, those are sitting longer. The condos are sitting longer, especially in Florida. But you've got pockets of homes that are sitting longer because they require a very specific buyer, and most importantly, a first-time home buyer isn't necessarily buying those homes. The first-time home buyers are the ones jumping in right now. The move-up, move-down buyers, they've got rates below 3%. They're not making a move, and we've been hoping all along rates were going to fall to free up that freeze at the bottom of the housing ladder. So those people who had first-time homes that they bought in 2020 could sell them now to buy their nicer home because that's what they want to do. But they can't. They can't because they can't afford a home payment at a 7% interest rate, which is what we're tickling right now. So it's creating two dynamics where I got a whole bunch of first-time home buyers that want to buy a home. And they say, I can't find anything. The competition out there is so tough. And yet I've got a lot of sellers that say, I can't sell my home. Nobody wants to buy it. How can both those things be true? Because they're not in the same market. The first-time home buyers are buying first-time homes, smaller homes, less expensive homes. The people who are selling those homes can't move up because they can't afford it. The people who are selling are ones that have nicer homes that want to get rid of them, and there's nobody to buy those homes. It's creating a major challenge, and I don't know what the solution is short term. I think we're going to see some markets where things are going to be a lot more challenged. I think we're going to see some more foreclosures coming into the new year because people are struggling keeping on top of their HOA dues, keeping on top of their property taxes. I think we're going to struggle with people who got temporary buy downs over the last couple of years saying, hey, I'm marrying the house and I'm dating the rate. Well, guess what? That relationship with the rate was an abusive one and it didn't work out so well. And so I got to divorce the rate. And the only way to do that is to sell my house. I have a client right now that just is closing escrow, signing her documents, I think today, and closing escrow on Monday on a home that was bought 2 years ago using a first-time home buyer program, 0 down payment, and that client is selling without making any cash out of the property. They actually almost needed to do a short sale because the price hadn't gone up, and the buyer ended up raising the price to make up for it. So there are definitely cracks showing in the market. All right, so I've got more comments. Let's see what I've got here. I have got a lot of comments. All right. So I got a Dream for All comment here. With Dream for All program, after the shift from primary lender to other provider, it doesn't matter if we pay some amount of principal. Okay. All right. So what you're saying is, first of all, once you get the mortgage, you can pay down as much principal as you want. The only thing that Dream for All can do is say you cannot put more than 5% down. Once you take out the loan, you can put as much money as you want towards principal. They can't stop you from doing that. When you refinance, you can pay down as much as you possibly want. There's no issue with that. All right. So now let's say here, I have to agree, no one trusts the Fed anymore because the economy is in shambles. I personally know 3 people who were approved for more than they should and fell for the date the rate scam. It's frustrating. I think, now here's where you say approved for more than they should. The date the rate thing didn't approve you at that lower payment. You were approved at the full payment. The mortgage industry, I don't think we can ever get it right. And I don't know that I blame the mortgage industry. I have people who tell me all the time, John, you aren't qualifying me for enough. I can afford more. And I have an equal number of people telling me, what do you mean I can afford that much? There's no way I can afford that. Because there's things in what you are spending every single day that we cannot account for. We can't know what your lifestyle is. How often do you travel? How much are your Disneyland season passes? How often do you go out to dinner? All of these factors that we can't know. I don't know what you spend for cheer for your child. So when you say, man, we qualified from somebody for way more than they could afford, well, I look at what's on the credit report. We take your total gross income and we throw away half of it. That's the half that we don't ignore is the half that pays for your property, your income taxes, pays for your gasoline, pays for your food, pays for your Disneyland season passes, pays for your clothing, pays for your travel, pays for your kids' cheer. Half of your income we set aside to pay for all of those things. And then we say the other half can be allocated towards things that show up on your credit report, your house payment, your credit cards, your car payments, your property taxes, and your insurance, your student loans. So for some people, they're like, John, I don't have any other expenses. I can afford to spend more of my money. Other people are like, John, how in the heck can you think that I can afford to spend that much money? I can't afford it. We have a specific calculation that we take, and it's really on the homeowner as well to decide to be an adult. I'm not convincing you to do anything. Maybe some of my peers are, I don't know, but I'm not trying to push you into do anything. I'm telling you the truth. The truth is there's two numbers and two numbers only that matter. The most you're willing to spend and the most I will let you spend. And we cannot exceed either one of those. But if I'm willing to let you spend this and you're willing to spend this, and then you change your mind and say you're willing to go higher, that's a decision on you. I didn't force you to do that. I won't let you spend more than the mortgage industry will allow you to spend, but nobody twisted your arm to tell you to go spend that. Now, again, I worry about some of my peers who said, oh, don't worry, you can marry the house and date the rate and your payment will never be higher than this. Shame on them for saying it. Shame on the consumer for believing that, because that's not what it said in writing. And this is the same thing that happened leading up to the crash in 2007 on a much, much smaller scale, where you believed somebody because they said, don't worry, I know it's going to work out that way. Trust me. This is probably the single largest financial decision you'll ever make in your life. And you don't just trust somebody when they say, don't worry, the paperwork says one thing, trust me, it'll be something different. All right. Let's look here what we got. Imagine all the people who tried to get their dream for all subsidized house when values go negative from when they bought. They have no skin in the game. Defaults are incoming. We are in for a reawakening. I'm not sure I agree with that. First of all, I have said many, many, many a time that if I had the option of going back to 2007 and buying a home and riding it out through the crash with a fixed rate mortgage, would I do it? And the answer is 100% yes. And I want to share with you why I say that. I'm going to go in here. Hold on. St. Louis spread. Average home price. Average home price. All right. So let me share my screen again right here. All right. Median home price for homes sold in the United States. Home ownership is a beneficial situation over the long run. It's the short run that we can't be too sure about. So if we're looking right here, and I'm just going to cover from the early 2000s up through the run up of 2007, house prices went up to $257,000. Now, let me uncover this because you can't see it. It's going up to $257,000. Make this even bigger, and hopefully you can see it even better. So we had house prices running up and up and up and up and up. And as a matter of fact, if we scooch backwards and we look kind of back leading up to 2007, we have from the 90s, we had a housing crash. But prices kept going up and up and up and up and up because that's what they do over time. Over time, prices will be moving up. But what we see is over a short period of time, we have prices correct. So we have prices correct right here. 2007, they went from $257 all the way down to $208,000. That is essentially almost a 20% price drop. Okay, that was a rude awakening for a lot of people. The market was in the shambles. And yet, if I could have bought a home here with a 30-year fixed rate payment where my payment didn't change and I could afford the monthly payment, what was the average mortgage payment on a $250,000 home in 2008? A lot lower than what the mortgage payment is today. And guess what? Today, I would have paid down a significant amount of principal because I would have made payments over the last 15 years and my balance would be significantly lower. So what's my point in saying that? Because my point is that when you say, hey, these people, when values go negative from when they bought, sure, values can go negative, but there's never been a 10-year period in the history of recorded numbers where housing prices have ended lower than where they started. And so if you're in it for the short run, you got to worry about that. You got to worry about the seller who sold to my buyer that's closing escrow on Monday. And that seller bought 2 years ago. If they said, hey, I only want to be here for 2 years and that's why they're selling, well, then that wasn't a good buying decision, knowing the volatility of the market that we were in. But if you're buying for the long run, and nobody knows for sure what the long run is, but if you think, hey, I can make it here 5 to 10 years, I can make it in this home. Most of the time with most of the crashes other than 07, we recovered in less than 5 years. 07 took a little bit longer to recover because it was a systemic crash. It wasn't just a crash that was because of a recession. It was a recession caused by the housing market. Whole different scenario there. So no skin in the game actually isn't the challenge. It isn't the precursor to default. No skin in the game really isn't what's causing people to lose their home. What's causing them to lose their home more often than that is the fact that A, they had no reserves for a rainy day. That's the number one thing I see, is that people, they didn't have reserves to cover, hey, I got a roof problem, I need to fix the roof. Or B, it's income issues. But as long as you have a fixed rate and your income doesn't change or go away, and you have a little bit of money in reserves to cover a rainy day, you should be able to survive through that 5 to 10 year timeline. That's exactly what a lot of people who bought their homes in 2020 and 2021 that we're all envious of. I'm one of them, but I mean, we're envious of right now because they got super low interest rates. But for them, some of them still are struggling. I have a client at a 4.5% interest rate that says, John, I'm struggling. I don't know what to do. It's going to take a long time for rates to get low enough to help them. I've got another client that bought in 2020 and they have a 2.75% interest rate. And they said, John, I'm struggling and I don't know what to do. They have to figure out how to last long enough. Now, they've got a huge amount of equity in their property, so they could sell it, but they've got to figure out how to make it through. So no matter where we're at, we always have challenges, but it has less to do with skin in the game, in my experience. It has to do with stability of income. It has to do with fixed interest rate and payment. And it has to do with, do I have any money to help me get through the rainy days? Because it does rain. All right. Let's keep going. My home scheduled to be completed in January. Given the current high interest rates, how soon can I refinance after purchasing? Oh, that's a juicy question. The answer is immediately. Well, FHA and VA set specific moratoriums that are essentially 9 months, essentially from the date that you buy the house. If you take out an FHA loan and you are refinancing with an FHA loan, or if you take out a VA loan and you're refinancing the VA loan, they're going to set rules that say, you have to wait. And I know that Okie Dokie says that the answer is never. He can never refinance. But the fact is that even in the current environment, we've seen rates as low as 5.5. Now, I just gave an argument at the beginning of this stream saying, hey, I think that there's a high likelihood, there's an argument that we won't see rates below 5 again unless we see a major shift where inflation is no longer an issue at all, and employment is the only thing the Fed cares about. But that's the only time we ever saw below 5% in the past. But that doesn't mean we're going to stay at 7. It doesn't mean that what's happening, the human condition is people have a hard time believing that anything's going to be different tomorrow than it is today. If things are great today, they just expect things are going to be great forever. If things are horrible today, they expect things are going to be horrible forever. The truth is, life is cycles. The market is a cycle. Right now, the cycle sucks. The cycle is bouncing between 5.5 and 7.5. And there's a good chance that's what we're going to see for the near future. But if you're at 7, can you refinance at 5.5? Yes, you can, Salvatore. And do I expect that you will do that? Yes. Now, a lender, if you don't have an FHA or a VA loan, your lender's going to say you have to wait 9 months anyway. That's not true. They're protecting themselves because there's a little known rule called early payoff, which means the bank who gave you the loan originally has agreed with Wall Street that you're going to keep your loan for a certain amount of time. And if it pays off before that, well, the Wall Street didn't make very much money in interest. And so the lender is obligated to pay back the money that we originally earned for doing your loan. So we did a loan and we made no money. So my only comment to my clients is, look, if the numbers make sense and you can refinance, the only thing I ask is come back to me, because I'd rather do a loan again a second time, lose my pay on the first time and get paid the second time. Doing loans twice and getting paid once is better than doing loans once and getting paid none at all. So hopefully that helps answer your question. Okie dokie, for the first time ever, Powell mentioned the housing market being weak, huge red flag. Maybe, there's a lot we can read into that, and I don't want to take forever on this podcast. All right, so depends on the city. Bay Area keeps going up so far. That's my point. It depends on the pocket. It depends on geography, and it depends on price point and who the buyers are. In reality, says the Bay Area is currently in a tech bubble. Once the bubble pops, layoffs are coming through. We saw the tech bubble in 2002, 2004, that era. We didn't see significant crashes in the housing market in the Bay Area. I grew up in the Bay Area. My parents sold their house in 07, 08 when my dad passed away in 07. That was a horrible time to sell, and they still sold for over $1 million. And they bought the house in 1973 for $40,000. So the Bay Area, that market has a lot of things going for it. I don't see that market crashing. We've seen bubbles. We've seen where prices skyrocket, and then we see where prices level off. I think we are in a leveling off period, potentially, if that happens, but we're not going to see a crash, in my opinion. All right. It's still not bad if you're thinking of living there for a while. There you go. You bought it with Dream for All at 6.1 this August. The value's already gone up $40,000. Plus rent is similar to the monthly payment. Yeah, there's a lot of great dynamics. I believe you completely. And Okie dokie, Dream for All was low to medium income. They can't write out fixed monthly income. Again, okie dokie, I get where you're coming from. I want to give you your opportunity to speak as well. So I'm happily sharing your comments. But look, I get it. We all can have our own perspective on what's going to happen. I want to kind of wrap this up here in the next couple of minutes and say, look, I don't think it's doom and gloom, but I don't think it's roses and ice cream for everybody either. I think that the challenges that we're dealing with are going to shift. I think that becoming a homeowner is hard. Okay. The truth is all good things in life are hard. The best things in life come on the other side of challenges and perseverance. And so it shouldn't be easy. If it was easy, everybody would do it, and then there would be no value in it. I mean, that's the truth. We got another comment here. Value is not up until you sell. Again, you're right, but you can't be doom and gloom on both sides of it. So when the value drops, the value isn't lower until you sell. So you can't argue and say that, well, that doesn't count and poo-poo the conversation or the argument by saying the value being up doesn't matter until you sell, because every drop that we've seen in history has been followed by a significant increase down the road. So as long as you don't have to sell, the value didn't drop until you sell either. You've got to look at it both ways. All right. I enjoy this. Okay. So last thing real quick, Dream for All update. We are clearly seeing the numbers come down. We obviously had the issue earlier this week where late last week, a week ago today, where Cal Haffa accidentally made everybody on the waiting list number one. That obviously has been fixed. You've been restored to your number, but I'm seeing numbers come down even more. Cal Haffa has said that they are calling people on the wait list, asking them, hey, are you still really waiting? Do you still want to buy? And they're encouraging those people to cancel their spot on the wait list. I think that's what we're seeing right now, is we're seeing those people coming off of the wait list because they are not worried about waiting anymore. And we're going to see next week, probably either Friday or the following Monday, that we're going to see the vouchers being issued for the original people that were given vouchers back in June that got one extension. As of 2 weeks ago, there was a little under 300 people in that stale category. I know of at least 3 or 4 that I've talked to that have since gotten vouchers redeemed and found a home. So that number isn't going to be 300. I'm guessing maybe 200. And it's going to be divvied up over the entire market. But we're looking at, at least a 10% of the original vouchers issued will be reissued. And remember, we continue to get more vouchers issued every time that one person buys a home for less than $750,000. That leaves some extra money that gets scrapped back together and balled up into new dough, just like when you're making Christmas cookies and you got the little edges left over, you ball them up in a new dough. And as soon as you get enough for a new cookie, you put it down together and you stamp out a new cookie out of the scraps that were left over, because they just gave, and they only give enough money where every voucher issued, there's enough money to back the entire $150,000. But a majority of the people are not using the $150,000. So that's leaving more room for more vouchers to be created, even after people have been, even after people have used the voucher. So guys, thank you so much. This was a fun episode, a fun conversation. Really enjoy having the opportunity to guide you through the process. Remember, obviously we've had a lot of questions already. Remember, I am interviewing for the job of being your lender. And so if you are interested in talking with me, I just spoke with another home buyer this morning who has dropped down on the LA County list, and we talked today, gave him some information, and we'll be able to get him going. So if you are getting closer to the top of that list and you're not sure if your lender is going to guide you correctly, scan this QR code. Whether you're a Dream for All person or you're looking at just any other type of loan, I am interviewing for the job to be your lender today or in the future when it's time. Thank you, everybody, for listening. Have a very, very Merry Christmas, and we will see you guys next Friday for a holiday edition. Talk to you soon. Bye-bye.